Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge that you subscribe or say that you like this podcast on whatever platform you happen to be using. Got a good program coming up. My panelists will be discussing whether the overall market is keeping up with the big advances in the indices. Also, the holiday shopping season is now underway. We'll take a look at the early returns of consumer spending, and my panelists will give their thoughts on cryptocurrencies. It's coming up on The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, Michael Godwin of Fregasso Advisors, and another one of my regular panelists, Carrie Coghill, could not be with us today. So joining us is Shana Bielek of Coghill Investment Strategies. Thanks so much for all of you joining us once again for The Bull, the Bear, and You. Shana, a special welcome to you. Thanks for joining us once again. You've been a guest on the program before. Let me go into this right now. It's been about 2 weeks since last time we met, and in those 2 weeks, all-time closing highs were set by both the Dow and the S&P 500. The NASDAQ was within 100 points of a new closing high when the market closed on Friday afternoon. Now, we'll get into how the markets have fared for the year when we meet again before the new year, but suffice it to say, the gains in the indices have been significant for 2024. So, Michael, for a while this year, the indices were outpacing the rest of the stock market, most of the stocks. Is that still the case?
Yeah, I mean, I think what you're asking there, Stacy, is have we seen a more of a broadening out of performance amongst stocks? I mean, for gosh knows how long, 5, 6, 7, 8, 9, 10 years or so, it was the FANG stocks and the Magnificent Seven, and just that couple areas of the market that were just really outperforming and carrying the overall market. But over the past month or two, we've started to see some of the sort of forgotten segments of the market, such as small cap stocks, both value and growth in the small cap sector, begin to perform much better than we've been accustomed to over the past, again, 5, 6, 7 years or so. And even some of the sectors within the S&P 500 that were in the doldrums for much of the year, consumer discretionary, I'm sure Kim could talk about that a bit, they've done very, very well since the election. I guess, the question is, will that last going forward into 2025? I think, not to a surprise, certainly to Kim, I'm a little bit more skeptical on that. I think the market is just going to end up gravitating to where the growth is and not maybe where policy may be headed, which is really what's driven the market, I think, over the past month or so. And we're really seeing that play out today in the market, Stacy. We're recording this on Monday, the 2nd of December. I mean, it's really back to sort of growth in the markets today, where tech and communication services are really, really outperforming, in those more cyclical proxies or even defensive proxies, utilities, industrials, energy, et cetera, are really lagging today. So I'm not going to say that it's going to be a continuation of what we've seen over the past 7 years or so, but markets care about earnings, and some of those growthier sectors is really where the earnings have been and probably where they're going to continue to be even as we progress into 2025.
One of the things that drives the 70% of the economy that's consumption is the people. And with the election, the prospect of growing population will shrink. And without growing population, the consumer discretionary and consumer goods types areas of the market will have probably a tougher row to hoe to grow. To maintain, they should be fine. And we have I think we're going to continue to have a wonderful safety net under our economy with Social Security and the like, but the growth requires growing population, and that's really a worldwide problem. It's not just domestic, and actually we may be growing more than the rest of the world, but we're barely growing.
Shana or Kim?
Well, Michael's trying to throw me under the bus here. Totally kidding. I just thought let's stir the pot on today. No, you're right, Michael. I'd agree with you that policy in the long run, changes in policy, even perceived, hoped for changes in policy, are not things that should drive a market for very long, if at all. Don't go into those head fakes. But I do believe there's been some upward momentum with shoppers, and a lot of it has to do with gas prices. I don't know if you've filled up a car recently, but gas prices really have dropped precipitously. I'm somebody that has a car that needs higher octane. So I've been, really kind of hurting these last couple of years buying the premium, level of gas. And, that's come down, and it's really come down a noticeable amount. I'm not convinced, however, and we'll see on Friday, about what the jobs picture is looking for the lower 2/3 of the economic pyramid, we'll just call it. I think jobs are kind of on the tough side, and it does feel, and I think we saw this, actually we didn't see this in the PCE numbers. We saw wages going up nicely, but we'll see about jobs. And that really is what causes people to spend. So, but I believe growth drives any kind of price for a stock. We are aligned on that. So no bus throwing under on that one, Michael. And it does seem like the consumer for the past maybe month and a half is sighing with relief, and maybe it's gas prices.
Yeah, I did actually fill up my car this morning, Kim, and I was pleasantly surprised to see how cheap it was. Now again, I fill up my car with regular gas. I'm more of a man of the people. You're more of an elitist and have to get those expensive cars with that expensive gas. But it was great to see that. Yeah.
Yeah. Well, it's just that I need to go fast, as they say in Ricky Bobby Land. That's what drives my preference of car.
And I barely drive because I live in town, so I haven't filled up lately. But I have been certainly, we've been watching the market, and this is typical, holiday season, the November, December strong months of the market. We saw that with the November results of strong performance. I think what's interesting is, as we talk about these Mag 7s, is looking at performance. In 2023 they're up 76. 2024 they're up about 35, at least 35% the last time I looked. So we've been actually looking at the S&P versus an equal weight index. And to Michael's point, we are seeing more broadening, more small cap participation there. So that gap between the S&P 500 and if you were to take all 500 stocks and equalize them, that gap is starting to narrow, which we haven't seen in at least, starting in early 2023. So hopefully December follows the footsteps of November. And obviously this is a big week, so we just have to stay tuned on all the economic data that is to come.
When you talk about equalizing these, I know Michael and everybody else here has talked about this before, but once again, the S&P 500, it's a weighted indice. In other words,
Right.
Am I right on this? That the larger the market cap, the more weight is given to it?
Correct. And that's why the Mag 7 has such an influence on market returns and has since last year. So kind of looking at it, if they were all equal, that return is different. And we've been kind of tracking that over the last 12 to 18 months. So that's starting to narrow.
Okay, I do want to bring this up. Michael, you mentioned that, policy versus growth. Doesn't policy at some time, though, affect growth? I mean, if a certain policy is put into effect?
I think at the margins at best, Stacey.
Okay.
I mean, we're such a big economy that the president can influence certain stocks, maybe even sectors, but the broad market as a whole, they generally can't move and impact the broad market as a whole. Again, certain things they can do based on their policies and what they want to do, deregulation. So yeah, financial companies might do a little bit better because there's less regulations there and whatnot. But from a broad market standpoint, I just don't think a president and the policies can impact or move markets more than maybe a 1 month period, but certainly over the long run, that's not really feasible.
And I'll pile on here. Even anticipated changes in regulation can help a stock, but you have to actually see it work its way through the balance sheet and the income statement to really see how a change in regulation is going to affect a company's earnings. And at the end of the day, all we're looking at here is, to some extent, who grows revenues, but really shareholders should be concerned about which companies grow earnings, because that is what you're buying, is an earnings stream, a cash flow stream, for the most part, when you buy a stock.
And you also want to look at, I mean, for Gasso, an investment management company. That's what I do. But we're also a financial planning firm as well. And Carrie's talked about this before. There's a lot you want to do in regards to policy in terms of your financial plan going forward. There's a lot of tax implications that are going to be coming down the pike in terms of what you're going to want to do in terms of, any sort of financial planning, estate planning, et cetera. And that's really what we focus on a lot in as well as, what Kim pointed out on the individual stock side of things. But that's this tangible stuff that you can really, really have an impact on for, our clients and their financial plan and what that's going to look like in the years to come.
Okay.
It's one
good.
thing that also,
Yep.
Stacy, may be holding the market up a little bit. If you look at the prospect of maybe some tax changes next year, it may behoove people to not take profits this year and wait until January. I'm going to be kind of curious to see if there's any teeth to that statement, but we won't know until January. Because I think there may be some pent-up selling. People are just waiting until next year as opposed to having it this year. And I know that in the past, we've looked for tax losses to harvest. They're hard to find these days. And so people might be deferring taking profits simply because there's not much they can do to shelter them.
And with the anticipation that a new tax package, either the current one will be renewed or some other changes will be made.
Well, in all probability, it'll be renewed, mostly. Certainly the capital gains side shouldn't get worse. Maybe it'll get better, possibly.
Yeah, okay. Well, the traditional holiday shopping season is now underway, and as we noted before, consumer spending makes up about 70% of the economy. The early returns show that spending in the stores and online was up 3.4% compared to last year. I'd like everyone's take on this, on how it might affect retail stocks, but Kim, I'll start with you.
Well, God love that consumer. If there's at all any room on that charge card at this time of the year, they're using it, right? And this should be of no surprise to anyone here. Whenever I go out and actually shop, physically in a store, I actually ask the salespeople, so are things better or worse than last year? And most of the kind of places I go to, the people have been there more than a year. And it's looking like there was a bump in year-over-year spending this year. Although I will say this too, I've seen a lot of good deals, and that will eat into businesses' margins, but I think they've learned they'd rather have people spending today rather than waiting to the end of the holiday season for gifts and going, well, maybe, I won't spend so much on whoever. So they have a lot of merch. They are certainly selling it. And it wasn't the crazy kind of door-busting deals that people used to do in years past. There is a lot that's done online. And today, God bless them, I think I can hear the sound of credit cards being typed in, into everybody's websites, even as we tape this.
When you say some people might be cutting back, you're not going to cut back on us, are you, on your shopping?
No, never.
Oh, okay. All right.
Never.
Sure. All right. Sorry, Shana, go ahead.
No, I think it's interesting because I remember the day after Thanksgiving, you had to get at the mall, you had to be there at 6 a.m., you had to wait in line for a limited amount of product. And now, obviously, with everything with technology, things have changed. But I think that a lot of the retailers consumers are more price conscious. So I think the retailers are picking up on this given what we've experienced with inflation. So the deals that Kim's referencing, I mean, it's crazy, the deals that are out there, and it's not just Friday any longer. It spills all throughout the weekend, and it'll continue, of course, for today. So, but they are still spending. I think the one thing that we've been looking at is to credit cards, to speak to that, of just watching credit card delinquencies and really just paying attention to the health of the consumer. I do believe that they're out there spending. We see it in the numbers. But we are looking at credit card delinquencies, seeing a small little uptick, and mainly the younger generation. But nonetheless, that is something for us to watch for the future.
All right. I do have this question. when we talk about being up 3.4% compared to last year, does that take into effect inflation? Or, I mean, in other words, are sales, it, are they better necessarily because of inflation, because they're bringing in more revenue, or is it actual increase in amount of money that past inflation?
They're not factoring in for inflation.
So sales, in a way, could actually be down depending on
We'll
how
see.
inflation is.
Sales.
I'm sorry, Frank?
There's unit sales versus dollar sales. And
Right.
You're suggesting that possibly unit sales are not up because of inflation.
I'm not suggesting, and I'm just asking whether that takes into consideration this. When we talk about an increase of 3.4%, I presume we're talking about dollar sales, right?
Yes.
Okay. So if inflation is still running at 2%, or maybe even a little higher, then that may not be a 3.4% increase.
But then you have to say last year it was probably running hotter. So, now we're into the real math problem.
Yeah. And there are no
Well put.
mathematicians. All right, great. The Fed meets again in about 2 weeks. One thing the board will be considering is and I think, Kim, you made mention of this before, the Personal Consumption Price Index, which is now, I'm going to say, another fancy way of the gauge of inflation. It was up 0.3% in October, which is higher than the Fed would like, and some say it is an indication that the fight against inflation is stagnant at this point. The latest unemployment numbers will be released on Friday, and of course, if you couple, I'm going to say, those two data points with the talk of higher tariffs under the new administration coming in, what kind of an effect might this have on your investments, if any? It's up to any of you want to answer that.
The Fed, I think it's almost undoubtedly clear now that the Fed cares more about the unemployment rate than they do about inflation. So the CPI number, I think we're going to run higher. We're not going to get closer to 2%. I think we're going to be higher than 2% for the foreseeable future. But the Fed really, really cares about that unemployment rate and that U3 number, the unemployment rate creeping up higher than what they deem to be full employment. So that number to me is going to be much more important than the CPI number that comes out for certainly this go around. The market's currently pricing in about a little more than half of a chance of a rate cut in December. 65% is the number right now, so 65% chance of one more rate cut in December. But again, a lot of that's going to be predicated on what the unemployment number looks like, and again, I think to a lesser extent the inflation number, but obviously they still pay quite a bit of attention to that.
I just have a word of caution on the whole PCE. It is overweight by housing, and housing continues somehow to creep up, the cost of housing. So, we have to take these numbers with a grain of salt, understand where they come from, and to not just apply that universal rate of inflation across everything. It's an extremely soupy mess, we'll just say, of numbers. So it's hard to use that to then infer what's going to happen in the future.
The housing market, and from what I can see here, seems to be leveling off. In my neighborhood a year or so ago, when homes came for sale, the next day they were sold. Now my next door neighbor's selling his house, and it's been on the market for a month. Another friend of mine over in the next neighboring community development, his house has been on the market for 3 months. So I'm seeing this is not what's been happening, and with this very small sample size, I suspect we're seeing a leveling off, a little bit of resistance to this growing price, at least in Pittsburgh. I can't speak to the rest of the country.
And Stacy, to answer your question about, obviously there's a lot going on with inflation and jobs, and I agree with Michael. I think we're, in addition to unemployment, looking at job growth. We've seen job growth start trending downward over the last 6 months. But to answer the question about, what do we do about it as advisors? First and foremost, we got to wait for this data, right? It's going to be very, very telling. But then we really, at the end of the day, need to really look at the economy. Is it growing or contracting? And if the economy starts to slow, or we see the consumer start to slow, we might make some shifts from decreasing growth, adding to value. On the bond side, we might be lengthening our duration. So I think after this week and in the coming weeks, I think we're going to know a lot more, and that will be the decision point of, do we make changes, if any, to client portfolios?
Thanks for being the one here, Shannon, to actually answer Stacy's question. That's what we didn't do.
Well, with what you just said, though, in the past, the panel, rightfully so, you're in for the long haul, and so you can't
Yeah.
have a knee-jerk reaction to some of this information, correct?
That is correct. But if we do start to see the economy slow down, there are some small shifts that should be made. Growth has had a significant run, and to our comments earlier about now seeing value start to participate a bit more, you may want to make some small tweaks. Maybe nothing overarching, but it does give good reason to take a look at client allocations of our portfolios. We'll see.
I tend to run against the herd a little bit on the allocation side of things. I tend to be a little more strategic. And that being said, when I look at the Standard & Poor 500 trading at 25 times projected earnings for 2025, which is an incredibly high number, even with these interest rates. And knowing that often projections are a little higher than reality when it's all over, as an example, earnings, with 95% of the earnings in on a Standard & Poor 500 for the third quarter, they are running at a record. And that record is at about 2% higher than the prior record. And when the prior record, the Standard & Poor was at about 3,500 or 4,000. Now it's close to 6,000, and the earnings are only up about 2% from that point. I personally think the market's a bit ahead of itself, and we've got to have more. We've got to have tremendous earnings growth to maintain these prices, unless interest rates go back down to where they were during COVID, which is zero. And I don't know anyone that thinks that's going to happen.
I do want to bring up this question, as long as I can remember exactly what it was, which I can't at this moment. But I know what it was. Frank, you talked about housing, near where you live. Would you say that the areas that you're talking about cater more to the older buyer or middle? Yes. Okay.
Yeah,
So
where
that
I
then,
live
yeah.
caters
So that.
to people like you and I.
All right, so that plays into the thing that if people had a very low mortgage or they have already paid off their house, they're not really interested in taking on a 6 or 7% mortgage at this point. Probably.
What was happening a year ago, realtors told me, is people were buying for cash. They weren't even borrowing money.
Yeah.
Right? Which I don't believe that's standard for the real estate market. It might be standard for the neighborhoods that you and I live in. All right, but I don't know that that's standard around the world. I mean, young people, I can't imagine have that much cash laying around to go buy a house.
Yeah. But back to that consumer number, that 70% driven by the consumer, you think if mortgage rates aren't at 6.8 and there is more inventory, then people are buying homes and just stimulating the economy because they're out shopping to fill their house and their sheds full of stuff.
Yeah.
So that's the flip side. Hopefully they can figure out a way to break this bottleneck in housing loose. I tend to think out of the box, and I can come up with no suitable idea that makes any sense whatsoever as to how to break this logjam.
Well, it will break at some point, but who knows how? Exactly right. All right, I'm not asking any of you to divulge your secret way that you tell your clients how to invest, but I do want your take on cryptocurrencies. And I'm bringing this up is because it's possible the Trump administration will refrain from trying to force crypto firms from adhering to regular Wall Street rules. Anybody want to dive into this one at all, or just let it go?
Kim does. Kim, go ahead.
Okay, this is the second time today I've been asked about this. This is why,
That's because there was an article in the Wall Street Journal about it. That's probably why.
Oh, maybe. Yeah, okay. That makes sense. Yes. Anyhow, I was on another video broadcast today, and I will give you my take. While I think, I don't know about any of the other coins. Let's just talk about Bitcoin itself. I think it has been driven largely by Chinese individuals trying to get cash out of China because it's very difficult to get cash out. But you can go across the border to Macau and open yourself a cryptocurrency account and shove some money across the gaming table and say, oh, here's my winnings, and take your money out of China. So that has been a driver of the beginning of crypto crazes, each one of them in 13, 17, somewhere in the 20s. Just recently, China tamping down on crypto has started this. No one uses this actually to buy things with. It's not really a unit of what we consider money for, where people will take it and trade. And finally, I'm only interested in cryptocurrency when I can pay my taxes in it, because that makes it legal tender.
Pretty well summed up there. Anybody else?
As far as the securities laws in crypto is not a security. If it is a currency, which by my definition of currency, I don't believe it is, but they call it a currency. If it's a currency, then it should be regulated by the banking rules, not the securities rules. Beyond that, I have no opinion other than we invest, I think every one of us invests in businesses. Crypto is not a business. It's like
there's not much I could say about it, just because it is unregulated. But what we do get asked the questions from our clients, it's a speculative instrument investment, and what we're trying to create for our clients is create some consistency, right, and help them plan for their future and leave a legacy and sell their business and all of these things. And when you introduce something speculative like that, something that could in one day be down 30% and happen continuously at total randomness, that doesn't create for a long cohesive plan for a client. So we pretty much, I'm not even able to really say much more than that, so before compliance gets me.
But all of you can understand the appeal to some people, because they see all of a sudden, if you had invested, quote unquote, into cryptocurrency, 3 years ago or 4 years ago, and all of a sudden it's busting through, and it's at, I can't even tell you what the last amount was, $85,000 per coin or something like that.
Closer to 100,000.
Is it closer now to 100,000?
Bitcoin.
Yeah, Bitcoin. I mean, you can understand why people think that this might be the way to go.
Sure, but but we look at businesses and balance sheets and things that we know. It's this unknown value, right? It's the value of what someone's willing to pay for it. So it's hard to, in our business, we always like to find a benchmark or a time period to go back and reference, and you can't do that with cryptocurrency.
You're investing in, it's a mania. I get it as well. I mean, it sounds great. I can make thousands and thousands of dollars really quick because everybody wants to buy this. Same thing happened in the tulip mania in the 1600s. Everybody wanted to buy tulips because it was quick. It was a quick way to make a buck. The problem with Bitcoin, for me, is I couldn't tell you why it would be valued at 92,000 or 35,000. There's no cash flow to it. There's no way for me to value that. Gold, at least, has been around for thousands of years, so you can get a better idea of what the value of gold is. Gold has some useful cases too, but that gives you a better idea of what the value is over the long haul. Bitcoin, I couldn't tell you whether it's correctly valued at $92,000 or $5,000.
And there is this air of I want to say academia around it now. I've been driving around listening to CNBC, and there are these people opining on why it should be higher and, giving you all these numbers. But they are fundamentally meaningless, as Michael points out, and, well, as everybody points out here. There is no underlying reason to buy it. And so you can't ever put a high price, a low price, or any price on it other than, oh, it just traded for that, and maybe it goes up and maybe it goes down.
We're going to wrap this up. I always go back to this point, and maybe I'm analyzing it incorrectly, but when you still say Bitcoin, it's worth X number of dollars.
Yes.
It's not worth X number of Bitcoins. It's worth X number of dollars. So it's still
Right.
tied to that, and it's just a interesting way for some people to make some money, I guess, or a lot of other people lose money. All right, thank you so much for joining us, Kim and Michael and Shana and Frank. And so we'll continue to look at investing and the economy in future editions. And once again, I ask that you subscribe or hit the like button on whatever platform you happen to be watching this program or listening to it. But for right now, thanks for joining us. We'll see you again in about 2 weeks. Thanks for joining us.